On Wall Street, you've got these massive institutions with just enormous resources and brilliant teams making huge moves all the time. People call them the smart money. So in this explainer, we're going to put on our investigator hats and learn exactly how to track their financial footprints. And that's really the heart of it, right? We're talking about two key groups here. First, corporate insiders. The CEOs and directors who know their companies inside and out. And second, the big hedge fund managers who have research budgets that are just staggering. What they do can be a massive clue. But here's the problem. These clues aren't just sitting there in plain sight. Nope. They're usually buried in these super dense, legalistic filings that often come out long after a trade was actually made. So, for the average person trying to figure out where the real money is flowing, it's a huge challenge. That's the billion-dollar question, isn't it? Well, turns out they do leave a trail. You just have to know where to look, and maybe, more importantly, how to interpret what you find. So let's start with the most famous map they leave behind. Okay, so our investigation is going to kick off with something called a Form 13F. Now, this is probably the most well-known and honestly the most misunderstood piece of evidence that these big institutional players have to make public. So what is it exactly? A 13F is basically a report that gets filed with the Securities and Exchange Commission, the SEC. Any institution managing over $100 million in U.S. stocks has to file one of these every single quarter. The whole idea is to give the market a bit more transparency, a little peek inside their playbook. Let's just break it down real quick. The who is the big fish, hedge funds, pension funds, you name it. The what is their long positions, which basically means the stocks they own and are betting will go up. And this is only for U.S. stocks. The when is super important. They have up to 45 days after a quarter ends to file. And trust me, we're going to come back to that. But this is where our map gets really incomplete. A 13F only shows you their bets that a stock is going to go up. It tells you nothing about their short positions, their bets that a stock will fall. It also leaves out how much cash they're holding or any stocks they own outside the US. You're literally only seeing one side of the coin. And this is exactly why that's so dangerous. A fund might report this huge position in a stock, right? But what if that's just an insurance policy for an even bigger, totally invisible bet against that same company, or maybe its whole industry? Without seeing their shorts, you have no idea what their actual strategy is. So not only is our map incomplete, it's also old news. The 13F is a look backward. To really get a sense of what's happening closer to now, we need to find fresher footprints. I mean, think about this for a second. A manager could buy a stock on the very first day of a quarter. You add the 90 days of the quarter, plus that 45-day filing window, and the information you're seeing could be 135 days old. In the market, 4.5 months is an eternity. So let's pivot to a much faster clue, the Form 4. This one tracks the people with the most intimate knowledge of a company. We're talking its own executives and its biggest shareholders. When they buy or sell their own company's stock, they've got to report it, and fast. And here it is. This is the game changer. Unlike that potential 135-day lag with a 13F, insiders have to file a Form 4 within just 2 business days of their trade. That's about as close to real time as you're ever going to get with public filings. These are the fresh footprints we're looking for. Think about it. When an insider buys shares, they're using their own money. These are the people who know what's really going on behind the scenes, and they're not putting their own cash on the line unless they truly believe the company's future is looking a whole lot better than the stock price is showing. All right, so we've covered public filings, but what about all the trades that are specifically designed to stay hidden? It's time to take our investigation into the shadows and have a look inside something called dark pools. Dark pools are pretty much what they sound like. They're private, hidden stock exchanges. The whole point of them is to let big institutions buy or sell enormous blocks of stock without tipping off the rest of the market, which could send the price moving against them before they're even done. And this, right here, might be the biggest aha moment of this whole thing. This isn't some tiny niche corner of the financial world. We're talking about nearly half of all U.S. stock trading happening here, off the public radar, away from the New York Stock Exchange or the NASDAQ. A gigantic amount of activity is happening completely out of sight. Okay, so we've got these old maps from 13Fs, we've got fresh footprints from Form 4s, and we've got these whispers coming out of the dark pools. How in the world does an investigator start connecting these dots and building a real story? Well, you're not looking for just any old trade. You're looking for signs of high conviction. When a really sharp manager puts more than 5% of their entire fund into a single idea, you pay attention. When you see multiple smart investors all buying the same, maybe lesser-known stock around the same time, that's a signal called cluster buying, and it is incredibly powerful. And a brand new position that instantly becomes one of their biggest holdings, that screams urgency and belief. This leads us to the investigator's method, which you can think of as clone, but verify. First, you spot these high-conviction signals and patterns. Then you try to figure out why. Why are they buying this? Is it cheap? Is there a turnaround story? But, and this is absolutely the most crucial step, you have to do your own homework. You use their idea as the starting point for your research, not the finish line. In this quote, just nails it. Blindly copying a famous investor without knowing why they bought, what price they paid, or if they've maybe already sold it, that is a recipe for disaster. Their moves should get you curious. They shouldn't dictate your own actions. Now, before we wrap this up, it is absolutely critical that we post some big warning signs, because following the smart money, as tempting as it is, has some very real dangers you have got to know about. One of the biggest traps is this sneaky practice called window dressing. It's basically when a fund manager sells all their losing stocks and buys a bunch of popular, hot stocks right before the quarter ends. Why? So their 13F report looks amazing, like they owned all the big winners. It's a completely deceptive snapshot designed to fool their clients. So let's just recap the key risks here. The data you're seeing is always incomplete and it's always old. Following the herd into a crowded trade can be really dangerous if everyone tries to sell at once. And as we just saw, some of the reported holdings might be totally misleading. You have to be aware of these dangers. Which leaves us with one final thought. We have more access to all this data than we've ever had before, but the big players are always finding new ways to trade and hide their tracks. In this constant cat and mouse game between transparency and strategy, who do you think really has the edge?